Right now, somewhere in Tokyo, a decision is being made that will determine how much the United States government pays to borrow money tomorrow. It is not made in Washington. It is not made by the Federal Reserve. It is made by a pension fund manager in Japan who is looking at a spreadsheet and asking one question: why would I buy American debt when Japanese debt finally pays a decent return? For 30 years, the answer was obvious. Japan paid almost nothing. The United States paid 4, 5, sometimes 6%. That calculation is changing. And when it finishes changing, every government, every mortgage holder, and every bond market on earth will feel it. To understand what is happening, you need to understand a financial relationship that has never made headlines but has quietly underpinned the entire global economy for 3 decades. Japan is the largest foreign holder of United States government debt in the world. Not China, not Saudi Arabia, Japan. Japanese entities, pension funds, life insurers, commercial banks currently hold approximately $1 trillion in United States Treasury securities. That is $1 trillion of American debt sitting on Japanese balance sheets. This did not happen by accident. After Japan's asset bubble collapsed in the early 1990s, the Bank of Japan slashed interest rates to near zero in an attempt to restart the economy. They kept them there for 20 years, then 30. When your domestic bonds pay almost nothing and American bonds pay 4%, the decision is not difficult. Japanese capital flooded into United States treasuries in an almost uninterrupted stream for a generation. The result? The United States government could borrow cheaply because Japan was always there, reliably buying. American mortgage rates stayed lower than they would have been. The federal deficit could expand without triggering a bond market revolt. Japan was not just an ally. Japan was the silent guarantor of American borrowing costs. Here is the question almost no one is asking. What happens when Japan stops? To understand the mechanism, you need to understand one of the most powerful and least discussed forces in global finance, the yen carry trade. The logic is simple. Borrow in Japanese yen at near 0% interest. Convert those yen into dollars. Buy United States treasuries yielding 4 or 5%. Pocket the difference. For years, this trade was effectively free money. Japanese interest rates were zero. American rates were not. The spread between them funded billions in leveraged positions across global markets. This was not a boutique strategy used by a handful of hedge funds. It was an organizing principle of global capital allocation. Estimates of the total yen carry trade position, including institutional and individual investors, run into the tens of trillions of dollars. The entire structure rested on one assumption: that Japan's rates would stay near zero indefinitely. That assumption is now wrong. In March 2024, the Bank of Japan did something it had not done in 17 years. It raised interest rates, then it raised them again, then again. By late 2025, the benchmark Japanese policy rate reached 0.75%, the highest level in 3 decades. Simultaneously, the Bank of Japan abandoned its policy of yield curve control, the practice of artificially capping long-term Japanese bond yields. The moment that cap was removed, markets set their own price. The results were immediate. The yield on the 10-year Japanese government bond climbed above 2.7%, a level not seen since the late 1990s. The 30-year bond yield touched 3.2%, the highest recorded level in history. Now run the calculation again. A Japanese pension fund manager is no longer choosing between 0% at home and 5% abroad. The choice is now 2.7% at home versus 5% abroad, in a foreign currency that carries exchange rate risk. The premium for sending capital to America has shrunk dramatically. The calculus that directed $1 trillion into United States treasuries is reversing. The world already received a warning. In August 2024, the Bank of Japan raised rates unexpectedly. Almost overnight, the yen carry trade began to unwind. The Nikkei dropped 12.4% in a single session, its worst day since 1987. American stocks fell, crypto fell, global bond markets lurched. That was a partial unwind, a tremor. The question is whether the full earthquake is still ahead. If this kind of analysis is what you came for, no noise, just the forces that actually move the world, subscribing takes 2 seconds and ensures you see the next one. Here is what is actually happening. In March 2026, Japanese sovereign bond funds recorded the largest single monthly inflow in history. Capital is coming home. One senior fund manager at Blue Bay Asset Management stated it precisely. The new money being put to work will not be going into U.S. corporate bonds. It will not be going into U.S. treasuries. It will be going into domestic allocations. At the same time, a series of United States Treasury debt auctions drew historically weak demand. The Treasury sold 30-year bonds at a 5% yield, the first time since 2007. A flood of new corporate debt is competing with government bonds for the same pool of investors. Now for the counterargument, and it is strong. Several major analysts argue that a rapid, systemic repatriation is unlikely. Japanese institutional investors, pension funds, life insurers are not day traders. They move slowly. Their mandates require international diversification. From January to October 2025, Japanese investors purchased 11.7 trillion yen in overseas debt, far outpacing what they sold. Furthermore, Japan and the United States are formal strategic allies. The idea that Tokyo would deliberately destabilize American bond markets as a policy choice strains credibility. And there is the simple reality of alternatives. Japan's own debt to GDP ratio exceeds 230%, the highest of any major economy in the world. Moving capital from American risk to Japanese risk is not obviously safer. Japan is not stepping away from the dollar system deliberately. It is being pulled home by the logic of its own interest rates. That distinction matters. Deliberate policy can be reversed. Structural economics cannot. There are 3 scenarios from here. They do not carry equal probability. Scenario 1, the gradual rebalancing. Japan slowly shifts its allocation over years, moving from 1 trillion in United States treasuries to 7 or 800 billion. The transition is orderly. American yields rise modestly, the Federal Reserve adjusts, the system absorbs the shock. This is the consensus view. It is also the most comforting. Scenario 2, the disorderly unwind. A sharp yen appreciation, driven by accelerating Bank of Japan rate hikes or geopolitical stress, triggers a rapid unwinding of remaining carry trade positions. Japanese institutions face forced selling of foreign assets to cover currency losses. American yields spike. The Treasury cannot find replacement buyers quickly. Borrowing costs surge at the worst possible fiscal moment. This is not the base case, but it is not a tail risk either. It nearly happened in August 2024. Scenario 3, the structural decoupling. Over 5 to 10 years, Japan's domestic bond market becomes genuinely competitive with American debt. Japanese capital, individual savers, pension funds, life insurers, systematically reallocates homeward. The trillion-dollar position unwinds, not in a crisis, but in a quiet, decade-long drift that permanently raises the floor on American borrowing costs. This scenario requires no panic, no political decision, no dramatic event. It requires only that the spreadsheet keeps producing the same answer it is producing today. The Japan bond story is not just a story about one country's fiscal problems. It is a story about the hidden infrastructure of the dollar system. For 30 years, American fiscal expansion was possible, not just because of the Federal Reserve, but because of the reliable presence of foreign buyers who had nowhere better to put their money. That condition is ending. Not with a dramatic announcement, not with a summit or a declaration, with a spreadsheet calculation in Tokyo that now produces a different answer than it did 3 years ago. The dollar is not just America's currency, it is the world's operating system. And the world's operating system has always depended quietly on Japan choosing to buy in. The question is not whether Japan's $1 trillion begins to move. The question is whether, when it does, the silence of that money leaving is the loudest sound the bond market has ever heard.